So you've already provided your pay stubs, your W-2s, your tax returns, and now we're asking you for them again. Why? During the pre-approval process, we're going to do our best job to pre-underwrite your file, meaning we're going to put our underwriter hat on and say, here's how an underwriter is going to view your income. Once we get your loan process going and you're under contract, we then actually have to supply updated documents to the underwriter for them to do your actual income calculation. Now, what does that mean? Underwriters look at how you earn your income differently based off it being a salary job, an hourly part-time, or even self-employed. They look at stability of income over those earning types as they build out what we call your qualifying income. And that's going to be how much money do we say you earn, which will then lead to how much of a home payment can you actually afford. The different earnings types are going to have different requirements. If you're salary in your W-2, it might just be your most recent pay stubs in your W-2s to show that you have a history of earning that kind of income. Again, history and stability are what they're looking for to make sure that they're likely to have their loan paid back. If you're an hourly employee, how many hours do you work? How long have you worked those many hours? Have you been with one company and you started part-time and then you went to full-time? And why? And what did that happen? Did your roles and responsibilities change? Down the line from there, there's self-employed. Are you a self-employed contractor? Do you own a company and do you pay yourself a salary? All of these are going to have various requirements for documents that we're going to have to supply in order to make sure that we get through underwriting and move forward toward approval. You may get a request to look at a pay stub from a year or two ago because that's going to break down the specific earnings types that you have. If it's overtime, if it's a shift differential, if it's bonus, the more earnings types we see and the more history we can show of receiving that, the higher the qualifying income we can give you and the higher or more of a housing payment that we can qualify you to afford. Self-employed borrowers is where things can sort of get tricky because there's different types of self-employed borrowers. There's just your regular contractor, somebody who's paid 1099 from their employer. There's a small business owner who actually runs a company, has expenses, and they pay themselves through that company. There's also partners that own companies together and they own equal shares of those companies, and the revenue and the tax liability falls equally over onto those partners. So that's where we have to actually get through and look at the history of tax returns. What do they say? What different earning schedules are on there to dissect to know what we can say, this is how much money they make based off of these tax returns. Once we do all that and we submit that to the underwriter is going to go through and they're going to check our work, essentially. They're going to go through and say, based off of what is on your application of how you earn your money, here's how the income should be calculated. And whether we got it right or not is going to determine whether or not that loan actually gets approved. One of the benefits of working with Simplified Mortgage is our team is built with former underwriters and people who have been in those positions to train and coach our loan officers to know how to do those up front so that when we sign off on or approve you or pre-approve you to go out shopping, we know that we have a really great chance that the underwriter who's going to look at your file is going to calculate the income the same way that we did so we can move forward with a seamless approval.